Apart from the central bank, and apart from the jobs numbers, what are the things that you're looking at there right now that could affect investors?
Well, I think that's a very good clip to go to because that's a reminder of the era when the Fed declared victory on inflation too soon and then had to go back and raise rates again. And for us, that's the biggest risk that happens again. We're looking at a number of things. I think the one most recently that's occurred is China is reopening. And suddenly you're going to have 1 billion consumers out there consuming. That's twice the size of the US and Europe put together. That could create a lot of pressure on the price of goods and services. The other thing out there that we're very mindful of is that the US and Europe got away with a very mild winter, and that kept energy prices low, as did releasing the Strategic Petroleum Reserve. What happens when we get into the summer and perhaps everyone's driving around, you've got to cool places, you're using a lot more energy, and the Strategic Petroleum Reserve is being rebuilt. That could put a lot of upward pressure on inflation.
So, Erin, what about it? Those are two very interesting risks. One is that inflation is not going away. The Fed will actually have to keep raising, or after pausing, have to raise again, maybe because of China. How big a risk is China in terms of inflation?
I think that China, with respect to global inflation and particularly developed market inflation, is actually going to be quite small. The way that we think about it from a growth perspective, it probably has about a 0.2 percentage point increase to U.S. growth and maybe 0.3% increase to European growth just because of the trade effects. And pretty similar impact to inflation, albeit potentially even a little bit smaller than those impacts. And that's because, typically in an environment where you see China growth really rebounding, those tend to be the typical effects to growth and inflation, to global developed market GDP and inflation. This time around, it could be even a little bit smaller, given the fact that the reflation story and the growth story in China is going to be really centered in domestic growth drivers and more service reopening drivers, rather than what you typically see, which tends to be more investment and infrastructure led. So this time it's going to be really focused on travel, getting back to work, getting back to, typical service oriented economy, which is very domestic China focused. It probably has a bigger impact into the region than the region and sort of the countries closest to China, rather than to the U.S. and to Europe and to more developed market economies in the Western world. And so I think that the effects are going to be good for China, good for maybe Korea, for Thailand, to Singapore, to Hong Kong, but not as strong as a driver for growth and inflation, in the U.S. or in Europe.
Although we did see the price of copper shoot up pretty smartly once China started to reopen. So they're out there competing for the same resources that the Western world is now. That's inflationary pressure.
Bob, what about broadly? To what extent do you take into account emerging markets in your decisions about bond investing? We're going to have Rashir Sharma on in a few minutes here talking about India. Is that a factor in making investment decisions, Bob?
It's an enormous factor as we look across bond markets. We've been very impressed with the emerging markets. We like to track the cumulative number of rate hikes since the start of 2021. The developed markets have done close to 4,000 basis points. The emerging markets have done over 22,000 basis points of rate hikes. They got in front of this. They raised rates. Real yields are high. They slowed growth and inflationary pressures. We can go into those markets, get high real yields, and you know what? We do think the dollar has topped. It will come down over the balance of the year. That's a pretty nice tailwind to local emerging market debt.
Erin, I think I cut you off.
No, what I was going to say was the biggest driver for inflation, particularly in the U.S., from a commodity perspective, tends to be energy. And we've seen, even since the China reopening, which started in early October, we've seen energy prices come down, fairly significantly, and gas prices also fall pretty precipitously as well. So while typically you would think that if it was going to have a significant commodity impact from China reopening, you would see that occur in energy costs, we've actually seen the opposite occur, which is why I don't think, just looking at the data and looking at what's transpired and looking at how China is reopening and the sectors that's going to be impacted, it's why I don't think you're going to see a huge, sort of impact to inflation from China reopening.
I hope that's right. I hope the Fed engineers a soft landing, but China is going to be out there consuming and spending. And we also have to look at Europe. Europe did not go through the pain that we all feared over the last several months. That's put them in a much better position to consume as well.